G'day folks, welcome back to another update for natural gas and the ETFs. The charts are still showing overall, longer term, the monthly and weekly are still bullish, although the daily's turned down with a retrace that we expected on our last video. We'll include some back testing which demonstrates how you could trade using one of two strategies. So don't forget to hit that like and subscribe button to support the channel. Before we go any further, make sure you've got to hear the outlook, and that's today is June 30th, natural gas fundamentals. Prices are projected to rise about 80% in 2025 compared to 2024, driven by increased demand from domestic consumption and exports, while production growth lags. BOIL, this leveraged ETF, aims for twice the daily return of natural gas futures. It is highly volatile and suitable for short-term trading strategies. KOLD, this ETF seeks to deliver twice the inverse of the daily performance of natural gas futures. It is also highly volatile and intended for short-term trades. And UNG, this fund tracks near-month natural gas futures, offering direct exposure to natural gas prices. It is subject to high volatility and roll risks. Investors should consider high volatility and leverage associated with BOIL and KOLD, making them more suitable for short-term trading. UNG offers a less leverage exposure but still carries significant risk due to market volatility. So for natural gas, we always look at the long-term trends first. So I've got the monthly, the weekly and the daily. And the price and the CCI above the moving averages, giving us a bullish momentum. However, there's no divergence on the monthly. However, notice this fair value gap down here, which is indicating a potential retrace to that point. This could take years to play out, so don't go placing short orders based on that alone. I'm just giving you some indications where the price will retrace at some point in the near term. On the weekly, the price is broken below the moving average band, giving us a weakening bearish momentum. Even though the CCI is bullish, they're giving us a mixed signal. We had a few fair value gaps back there, but they've all been covered by subsequent candles or wicks of those candles. So there's no real sort of concern there. If I zoom out, we've got a fair value gap down there as well, which coincides with this period back here as well on the monthly. On the daily, it's giving us a bearish momentum with the price and the CCI below the moving averages. Notice is here, shorter term, we've got two fair value gaps, a small one down here on the short side and a larger one here on the long side. So we might see a bit of a ups and down price movement in the coming days to cover those areas that haven't been covered yet. So again, bearish momentum on the daily. Now if we go to the intraday chart, you can see here on the 1 hour chart, got the daily here as a reference. On the 1 hour chart, it was bearish since this bearish divergence we had indicated back here. We had a fair value gap that was hit quite easily. In fact, no, sorry, that's not yet actioned. That's still to be actioned. So we might see a price retrace to the upside, and that coincides with the daily. But since that bearish divergence, we had the price collapse and come down to this point, and where we've got this, we had now this bullish divergence, which has actually actioned with the price moving above the moving averages. And you can see there, if I drew a Fibonacci between that range, it's gone well beyond 100% retrace. And at the very minimum, we can expect a 38% retrace level. On the long side, let's see what it's done. If we drew a Fibonacci from that low to that high, we expect it to hit the 38% minimum range. You can see there it's covered it quite easily. Broke just above the 38% and it's pulling back towards that moving average in the middle again. So a bit conflicted at the moment, bearish on the daily, but somewhat neutral on the hourly. So wait for this to break to the downside again before taking short trades. Now, if we look at the intraday, the 1 hour time frame with the daily, we would have taken short trades from this period back here around about the 23rd of June, 22nd or 23rd of June. And that's indicated here by the stop loss approach and the average down approach. You can see there it's averaged down near the end there. But what you don't want to do is you don't want to let it run when it breaks above the moving average. So you would have kept that trade on both of them during that decline. Let me just get rid of that Fibonacci for a moment. You would have kept the short period or the short trades happening there. And ideally you should have probably closed it out when the CCI broke into that moving average band if you were in profit. Now in this case, the stop loss approach closed out if you let it run through the whole period with about 3,185. And the average down was about 2,405 because it's got a bit of a drawdown. You've averaged down. So again, you don't want to do that, especially when you see a bullish divergence in this case. You should have closed it out at that point around there on both the stop loss and the average down approach. The stop loss at that point, yes, you would have done it actually here when the price broke above the moving average. The stop loss generating about 4,100, and so did the average down. So they're both giving you the same return. So for BOIL on the monthly, it's below the moving averages of the price chart. There's no CCI for it, but notice up here we've got these fair value gaps that haven't been covered yet. So these are very long-term plays. Obviously, we're not going to expect anything happening in the coming weeks or months. We're probably going to take years to play out. You can see that price movement has taken a couple of years, 2 or 3 years to play out down to that point there. But we've got fair value gaps up there, so we might see the price get to that point in the next few years. On the weekly, we did have this bullish divergence, higher lows on the CCI versus lower lows on the price. That eventually broke up, didn't go too far up before us finally breaking to the downside again. So that looks like it didn't actually play out with the full extent of the bullish divergence. At the moment, the CCI is bearish and so is the price, so just be cautious of that. No bullish movement at the moment. But we do have these fair value gaps up there, very long-term plays again on the weekly. On the daily, also below the moving averages of the price and the CCI, giving us a bearish momentum. Bit of a bullish candle at the moment today, moving towards that moving average band, but still predominantly bearish momentum. Again, there's those fair value gaps up there. Again, they could take weeks or even months to reach that point. Now, if we go to the 1 hour time frame, we'll look for any micro moves. So if you're going short during this period, should we take any short positions? And the hourly is saying wait, because both the CCI and the price are above the moving averages, giving us a slight bullish momentum. So wait for those to break to the downside before taking any short trades. So ideally, you would have taken short trades back here when the CCI broke below, and so did the price, and you would have taken those short positions, and you would have closed out. Your first entry should have been closed out at that point there when the CCI broke into the moving average band on that candle, and then re-enter it the candle afterwards, if you're following this on the hourly. And then again, close it out again when the CCI breaks into that moving average band on that candle there. Well, the CCI gives you an early warning exit before the price does. If you had waited till that point there, you would have missed out on a bit of profitability in your trades. This one gave you a bit extra points in your trade balance. So for KOLD on the monthly, it's bearish, the price below the moving averages. Also, the CCI is just showing a fresh drawing there. That's also bearish. We've got these fair value gaps up there longer term. Again, those could take years to play out before reaching in that area. On the weekly, likewise, with the fair value gaps, but the CCI and the price are below the moving averages, giving us a bearish momentum. And on the daily, we did have this bullish divergence back here, higher lows versus lower lows on the price, and that actually bounced and then touched our minimum range, just touched it barely, and then fluctuated in that range for some time, and it's still consolidating in that range at the moment. Now it's currently somewhat bearish on the price, but bullish on the CCI, so just cautious of that. You can see there that the weekly is also pulling up as well, so we might see a break higher possibly, but there's no divergence to signify that, so we're going to just, actually there might be a divergence there actually. Let's just draw that. So what we do is look at lows, higher lows there on the CCI versus lower lows on the price. That's a bullish divergence, and it may have already hit it, because if you drew a Fibonacci between that range there, you can see there it's already broken through right almost to the 61%. Now it depends where you draw these Fibonacci's. If you move it back to that significant high, again it's got some way to go to hit that 23%. So you always take it back to the previous high before that divergence started, and that would have been that area, as I said, and it's already hit around 50 to 61% in that range there. Now on the intraday chart, we look at the 1 hour chart. So even if you're considering going long based on the daily, you shouldn't be doing it anyway, because it's giving you a neutral positioning, bearish on the price and bullish on the CCI. You can see there on the hourly, it's broken below the moving averages, giving us a bearish signal. So during that little spike up there, if you're following this on the hourly, you should have taken some long trades on that one during that period when it was going long on the daily. And again, similar to the previous chart, you would have closed out your position, opened it up when the price and the CCI were above the moving averages, probably on that candle, and you would have got out when that CCI touched the moving average band at that point there. So on that candle there, that would have been a nice little gain going long. So for UNG on the monthly, it's below the moving average of the price band. The CCI is above it, so it's giving us a mixed signal. Bullish, that's because of the bullish divergence on the monthly CCI versus lower lows on the price. And that it's actually bounced slightly, but not enough to warrant or hit our target. But notice up here we've got these fair value gaps. So again, very long-term play. We might see the price retrace into that area. On the weekly, bearish momentum on the price and the CCI. And you can see there the CCI is still dropping off in line with the price. So just be cautious about taking any long trades. And on the daily, again, bearish momentum on the CCI there, down there, and the price. It's been sort of hovering above and below in the last few months, but again, just always focus on the current trend. If you're trading on the hourly, and that's where we go next, go to the hourly chart. If we're trading on the hourly, you go in the direction of the daily. So you would have been going long during that period here on the hourly when the daily is going long, and you would have been going short since the price on the CCI broke down in that little period there. So similar to the other strategy, you would have gone long and got out on when the CCI touched the moving average band. You can see there it's right near the top, giving us an early warning or early exit, and you would have gone short in one of those candles there, and you would have got out of the trade when that CCI touched the moving average band, again on that little candle there, giving you an early exit, maximizing your profits. So if you're new to trading and you would like a deeper dive into simpler explanation of the analysis, we are including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. And if you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across regions of the world's markets. Thanks, and talk to you in our next video.